Hey there, Lincoln here from bullacademy.org. Today let's talk about IPOE, the SPAC that's taking SoFi public in Q2 of 2021. On May 27th, the day after my birthday, is when we'll decide whether or not IPOE and SoFi can merge and go public together. But today let's focus on SoFi's Q1 2021 earnings that they just put out this morning. In this video, we'll cover record results on their members, on their revenues, on their Galileo product usage, as well as their EBITDA positive quarter and their net revenues growing. But before we get to all of that, if you enjoyed this video, do me a big favor and like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below on IPOE and SoFi and whether or not you're investing in the company and how many shares you have. I am personally very bullish on SoFi, so we'll get into that more later. Finally, before we hop into the video, if you want to support the channel, get more access to me, get direct access to investing questions, and reach more investors, then join us over at patreon.bullacademy.org. You'll get to engage in our Discord channel where we discuss the stock market every day in real time and share news and rumors so we can all do our own research, come back together, collaborate, and make better investment decisions together. That's how we're able to get into ChargePoint, CCIV, IPOE, and so many others early before everyone else found out. So if you're interested in all of that, I hope to see you over at patreon.bullacademy.org. Now let's hop in. First up in the SEC Securities and Exchange Commission report by SoFi is their membership growth. In Q1 of 2021, this year, they gained over 430,000 members to add to their existing 1.85 million members to bring them to 2.28 million members. That's growth of 110%. year over year. That's very, very good. That's exactly what we want to hear. That's more than all their prior quarters. The greatest one before this quarter was 90% in Q4 of 2020. And before that, they did 74% in Q3. So they're continuing to accelerate their growth in their membership. That's exactly what we want. That means that their marketing is working out. Now for the growth in product usage by SoFi members. And there's two categories here. One is all the products, and the other category is just financial services. And the difference is all the products includes their lending offerings, like their home mortgage, their personal loans, the student loan refinancing, all of that stuff, so lending. And then there's the other financial services products, which are SoFi Money, which is the savings and checking accounts. And then there's the SoFi Invest and SoFi Relay and SoFi Credit, and those types of products, non-lending products. So let's dive into these numbers and I'll show you what the differences are and why it's important that there's a separation there. In Q1 of 2021, SoFi grew all their product usage by 121% from 1.4 million to 3.2 million over Q1 of 2020. So their members used about 700,000 new products over Q4 of 2020 when they had 2.5 million usage. And now they have 3.2 million products being used across the entire ecosystem. And that is wonderful within itself. That includes the lending products and that includes the financial services products. So both loans and accounts like SoFi Money and SoFi Invest and SoFi Credit. But now let's just talk about the financial products, which is, in my opinion, even more important than the growth of the lending products for now, right? For now, this is more important in my opinion. Let's talk about it. In Q1 of 2021, they grew their financial products usage by 273% year over year. 273%. That's how much they grew their financial products usage by. And why is this important? This is important because the beauty of SoFi is that they've been able to vertically integrate centralized services. And you may know that my most important investment criterion is vertical integration and centralization. And why is that important? Because with vertical integration of centralized services, you increase customer loyalty by giving them a one-stop shop to achieve all their goals. You cut down your costs, your expenses, and your marketing cost goes down over time because you get to upsell, you get to cross-sell your other products to your existing customers, your existing members. That's why SoFi is so focused on using the words members right? They call their customers members because they want to keep them in their ecosystem. They're not just users, not just customers, they're members, because as members, they get other perks, they get other services that they can use to get their money right, as Anthony Noto loves to say, in the SoFi ecosystem. And that benefits everyone because the customer doesn't have to go to 10 different places to get a credit card, a bank account with high yields, right? To get a personal loan or a home loan or a student loan, or to refinance their car loan. It's all in this one-stop shop that is vertically integrated, centralized services. So the vertical integration cuts the cost of business for SoFi, and the centralization gives the customer all the stuff that they need, all the products that they need in one package. And that together helps SoFi sell more lending products, sell more of their margin positive products to these members, these customers over time. So they previously said that about 65% of their home mortgages come from existing members in their ecosystem. That means they don't have to go out there and market to those 65% of their customers in the home mortgage department. They already have them in their ecosystem. They just say, hey, we see you have all that money sitting in your account. Why don't you get a home mortgage and buy a house? Start investing, right? We see you have this much credit. Why don't you get our credit card, right? So all of this goes together. And that is why it's important that they grew their financial services products by 273% year over year. And now they said that 2.2 million financial products being used on your ecosystem. So I'm very happy about that because the financial services are their Trojan horse into their higher margin products in the lending department. Right? They make a lot of money from lending, but they get to keep their customers around for much longer and keep them happier and keep them promoting them to their friends and family to bring them into the ecosystem through their financial services. Because if you have all your money in their accounts, you're investing in the stock market through their invest arm, you're managing all your finances through their SoFi relay, you have your credit card on SoFi, all of that, right, is all in SoFi. And now they can say, hey, here's a mortgage, here's a loan. Want to go to school? Want to go to grad school? Increase your education? Here it is. And because you're a member, you get better rates. So all of this helps SoFi continue to dominate this space, right? This is beautiful to me. And we'll get into why it's going to be more important later on when we get to their projections. But I'm very happy with this, as you can tell. I hope you are too. Let's keep moving. Next up, another very important number, and that's Galileo. Galileo is the Amazon Web Services of fintech. Galileo is the infrastructure by which many other financial tech companies like Chime and Robinhood and MoneyLion and Dave all operate on. They all rely on Galileo to do their business, to get their customers' accounts set up. About 9 in 10 neobank online banks in 2020 were created through Galileo. And guess who owns Galileo? SoFi. SoFi bought Galileo in 2020. And this was such a great move by Anthony Noto and team. Very smart. So Galileo continues to grow and is going to be about 20% of the revenues over time. I think that's what they've projected. But right now, they continue to grow this service, and it seems like there's no stop in sight. In Q1 of 2021, they reached 70 million accounts created through Galileo across all their customers. And that was thanks to a 130% growth year over year over Q1 of 2020, when they were just at 30 million accounts. Now they have more than double that. So they say also that over the last 3 quarters, Q3 Q4 of 2020 and Q1 of 2021, they've had over 100% year-over-year growth in accounts created through Galileo. I love it. I love it. This is why I am so bullish in this company, right? This is the second reason. First, the vertical integration of centralized services that nobody else is doing. SoFi is in a lane of its own in that segment. And then they have Galileo, which is the infrastructure for many of the competition, but also their partners. Their competition are their partners because they get to upsell their customers, clients, to SoFi's products. And they get to extract more data about what customers need, about what people out there need in their financial lives to get their money right. And then use that to create even more products for them, like their recent weekly dividend ETF that they just released this last week, because they learn over time through all the data that they acquire across all their services. And they figure out what people need and then they give it to them. And now we're giving them even more money through this SPAC merger, this special purpose acquisition company merger. They're gonna be able to move even faster and grow Galileo even faster and grow the financial services even faster, get more customer loyalty. So all of this then boils down to more lending products being sold. This is why SoFi is my biggest position. If I could only pick two stocks, two companies on the public markets to invest in, it would be SoFi and then Cloudflare. We can talk about Cloudflare later. I told you guys that yesterday in my community post, so if you haven't seen that, go check it out. And also on Twitter. If you don't follow me on Twitter, feel free to. And that's at Lincoln W. Daniel, same thing on Instagram. So I share just quick thoughts there too, once in a while, but mostly on our Discord channel where we discuss the stock market in real time every day. So if you want more frequent access to me, join us over at patreon.boacademy.org. And don't forget, if you're enjoying the video, like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts on IPOE, SoFi, and all these results. And I need you guys to like the videos so that I can keep doing them, because YouTube will not promote my videos if you guys don't like them. Now let's look at their net revenues and their adjusted EBITDA revenues of Q1 of 2021. And then we'll contrast that to what they expect to do for the whole year of 2021. And we'll see if they're on their way to reach their goal. So in Q1 of 2021, they had $216 million in net revenues, adjusted revenues. Then there's their adjusted EBITDA revenues. In Q1 of 2021, they had about $4.1 million in adjusted EBITDA profits, which was far greater, about $3 to $9 million more than they forecasted in their Q4 2020 investor presentation. So they crushed this goal. They forecasted they have between $5 million in losses in adjusted EBITDA to a profit of $1 million in adjusted EBITDA. But they got $4.1 million in adjusted EBITDA profits in Q1 of 2021. So they just keep setting goals and keep beating them. There's not much more I can say about that. And then their profits, their adjusted EBITDA margin was about 2% in Q1 2021. They expected about -3% or 1%. And on the low end, that was a 5% beat. And on the high end, a 1% beat. So either way you cut it, they beat the goal. And this is great because they expect to be adjusted EBITDA profitable for the whole year 2021 for the very first time. So it looks like they're on track. Maybe, if they can accelerate the growth in adjusted EBITDA profitability, because they expect to do about $27 million in adjusted EBITDA profitability this year, which will be a big turnaround from $66 million in losses in adjusted EBITDA profitability last year. So they have a big goal ahead of them. They're still $23 million off of that, which means that they would have to do 23 divided by 3, about $7.66 million in adjusted EBITDA profitability for each of the remaining 3 quarters of 2021. That's a tall order, but we'll see if they can actually hit that mark. And since they're beating all of their marks so far, I don't I don't doubt them. Let's see if they can do it. The good news is that these results include a negative of $5 million due to a corporate interest expense, primarily related to Galileo seller note, which was paid back in February 2021. So they had this one-time payment that they had to make of $5 million for a seller note for Galileo. So that means that if you add on $5 million to their $4 million in just EBITDA, then they will be far above the $7 million that they would have to do for each quarter to reach their $27 million adjusted EBITDA profitability goal of 2021. So I'm feeling pretty good about this. And to put their net revenues in perspective, the $260 million in net revenues, adjusted revenues, was a 151% growth year over year over Q1 of 2020. So up and to the right, we're still going. And the final notes on this adjusted EBITDA section that they want us to know is that this quarter marked their third consecutive quarter of positive adjusted EBITDA revenues. And that was thanks to a $70 million turnaround over Q1 of 2020. So in Q1 of 2020, they had a $23.7 million loss in adjusted EBITDA revenues. But now they're at $4 million in positive adjusted EBITDA revenues. And that has helped them over the last 12 months reach $25.7 million in adjusted EBITDA revenues. So over the last 12 months, they were only $1.3 million away from their 2021 goal. So if we carry over the next 12 months and they only grow their adjusted EBITDA revenues by $1.3 million, they will hit their goal of being adjusted EBITDA profitable for the first time in 2021. So their goal actually is very much within reach. I've been liking these numbers so far, but now I'm even more confident in this investment, in having 4,000 shares of this company, in having it as at least 30% of my growth portfolio. So I personally am happy. That's why you see me wear my SoFi shirt that I got in 2019 as a customer. And yeah, I'm liking this. But before I get into more praises for SoFi, let's just look at their reiteration of their 2021 non-GAAP guidance as adjusted EBITDA. So they say that we reiterate our 2021 guidance. So they're saying, hey, remember that guidance we gave you in 2020 for 2021? We're keeping it. We're keeping that guidance. We believe we can hit those marks. We can hit $27 million in adjusted EBITDA profitability for 2021. For the first time, being profitable. Okay, I like it. I like it. So they say they have a graph here that shows their last 3 years of adjusted EBITDA revenues and their contribution profits and contribution margins. So what I'm actually very interested in is the contribution margins that they have here, because we can look at the EBITDA, but we've already seen those. But we can look at the margins. So their contribution margins in 2018 was negative 53%. That means that their products, each of their products in the aggregate, was contributing 53% losses to their profits. They were losing 53% on each of their products. That means that the cost of selling those products, those services, was way greater than what they got from them. That was an investment, because we saw that in 2019, that number, that contribution margin, went up from negative 53% way up to negative 6%. So still investing in the future of this company, losing $25 million in contribution profits that year. And then we see in 2020, it pays off. They get to 26% in contribution margins. That means that each of their products and services in the aggregate, on average, was contributing 26% to profits. That was a big jump between 2019 and 2020. Between 2018 and 2020, they made huge investments in their products and services to make this vertically integrated, centralized service hub for financial services and products. And it paid off. And in 2021, they expect to grow their contribution margins to 27%. So just about 1% more than 2020. And they expect to have contribution profits of $266 million from their products. That's not actual profits, that's contribution profits. That's the value that they get from selling the product, so how much they make from it, minus the cost of selling that product. So if it costs them $10 to make a credit card and give it to one of their customers, and they gain $15 from it, their contribution profit was $5, right? $10 cost, $15 in sale value. And the math, very simple, $5 is the margin, which is what, 50% margins? It's not bad. So let's finish with the bottom line. In 2018 again, remember this is the year of investments. They had almost 100% loss in their adjusted EBITDA margins. So after all of the value from all the services and products that they sold and whatever else they did and all the value they get from that, they had losses of 94%. They were losing almost 100% on their services. So the way I look at this is that they were investing in the future of the company. So they lost $226.9 million in 2018 in adjusted EBITDA revenues. In 2019, they did a little better. They were at negative 33% in adjusted EBITDA margins. That's $149 million in losses. And they kept doing better. In 2020, they cut those losses to negative 7% adjusted EBITDA margins. And all of those investments over those last 3 years now get us to 2021 guidance of 3% adjusted EBITDA margins. 3% adjusted EBITDA profitability margins. Positive 3%, which will get us to that $27 million in adjusted EBITDA profitability for 2021. That's the guidance, and they're keeping it. Love it. Love it. You invest in your future years before what you hope to get, and it pays off if you keep at it and you keep growing. And that's what they've been doing for the last 3 years, and it's paying off. It's paying off. And that's why I'm so excited, like I said before, about them continuing to invest in the growth of their financial services. The financial services don't make too much money for them. That's their SoFi money account. That's their credit card. That's their SoFi Invest. That's a SoFi Relay. All those things are great. They're services. They may make some money, but not much. They probably have mostly losses. But what it does is bringing customers, members into the ecosystem, and it keeps them there. It keeps them happy. It solves all their problems. And then over time, SoFi can say, hey, we see all that money sitting in your SoFi Invest and SoFi money accounts. How about you take some of that and reinvest it into your own business or into real estate? Here's a home mortgage. If you need to do a rehab on a house that you just bought, or you want to, start a business, here's a personal loan because we know your credit. We know that you are able to pay back because you use our credit card. And we know your credit score because we have all your accounts in SoFi Relay because we show you all of your financial health in a single place. So we know everything about you. So here's a personal loan. You want to go back to school? Here's a student loan. Right? All of those things. And do you need a car to commute to work or to commute to your customers? Here's a car loan refinance so that you can get a better loan for that car. All these lending products can be upsold to their customers, their members in their ecosystem at a much cheaper rate. All they have to do is put up a banner, put up a notification, and say, hey, Daniel, we know everything about you. Here's how we're going to help you get to your next financial goal. Because we're using all your data for your good. We're not Facebook trying to sell your data. We're trying to use the data to help you reach your next goal. And in return, we get a little bit of money to make some profit. because we're a business, we have to keep the lights on, right? So that's why I love SoFi. All these numbers show why SoFi is going to continue to dominate this space. And we haven't really talked about Galileo too much. Over the next 10 years, Galileo is going to be, for my guess, my educated guess, it's going to be at least 30% of the revenues. I think they're predicting 20%, but I think it's going to be even more. Because financial tech, financial services continue to grow, and SoFi is going to continue to improve Galileo and serve their customers, their business customers. And the more they do that, the more they can upsell their products because they get more data from their increasing partners. So all of this together makes for a great investment. For me, of course, my financial advisor, I can't tell you what to do, not to buy, sell, or hold. But for me personally, I am extremely bullish on this company, and I will continue to practice the bull mentality on SoFi and all my other investments. And if you don't know what the bull mentality is yet, the bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. And we can see that with SoFi. They've been investing for the last 3 years into their business, into the future of their business, because wealth doesn't come overnight. It takes lots of time to get right. It takes lots of time to make an investment pay off. They've been losing millions and millions of dollars, and this year, finally, they're going to get to Adjusted EBITDA profitability. And even before 2018, they were losing even more money. So you have to be long-term minded. Be patient. Your investments will work out. If you're picking companies that you know, understand, believe in, and plan to hold for the long term, that's why we preach that here on the channel. And it's not just a saying, it's a way of thinking, a way of helping you stay in the game for the long term, because we don't want to see you burn out. Don't want to see you try to get rich quick and then lose to all the hype and then leave the stock market because you think it's a scam. So I'm very excited about these numbers. I am not just trying to hype up SoFi because I don't really care what you do. If the stock stays cheap, it's great for me. I get to buy more. I was happy when it was down to $13 per share last month, so I got to buy more of it. I got to buy a whole lot more of it. I think I bought about half of my shares when it dipped so far, thanks to all the fear in the market. So I'll be even happier if it stays in the 16s for the next year. I hope so. And I'll keep buying it up because that's how bullish I am on this company. So I hope you enjoyed the video. If you did, don't forget to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below, because all of that helps me know that you enjoyed the video and helps YouTube know that, so that they can continue to promote my video across the interwebs and help me be encouraged to keep making these videos for all of you and share the knowledge that I enjoy sharing. And if you want to help me reach more investors, get more access to me, then join us over at patreon.boacademy.org, and you'll get to discuss the stock market in real time with us in our Discord channel and share news and rumors so that we can all do our research and then come back together, collaborate, and make better investment decisions together, because that's how we got into IPOE and CCIV Lucid Motors and SPE, which is now ChargePoint, and IPOB Open Door, and so many more. Sure, they may be down right now, but remember, it's a long-term game. And if you find great companies, remember that half the battle is knowing. So you gotta know about these companies first. So it's great to have a community that can share new investment ideas together and help everyone do research together. I am very happy for the community because they helped me find some of my best investments, including ChargePoint, including IPOE. So I'm forever indebted to our patrons, and I hope that you will join us over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again, and have a great day.